Hello viewers, welcome to UPSC Warriors channel by Unacademy. This is Soundarya. So today we are going to continue our MCQ series where we will be discussing some questions from the topic money. Already we discussed some 7 questions in the previous video. So if you have not watched that video, I would definitely recommend you to go and watch it. Now, we will start with the first question. Which one of the following correctly defines the term interest coverage ratio as seen in news sometimes? So this question is about the interest coverage ratio. Before going to this question, I would like to tell you something. Whenever you come across any term that ends with ratio, as far as economy is concerned, like capital adequacy ratio, leverage ratio, debt to asset ratio, asset liability ratio, I recommend you to go and find the meaning of the term. Why? Because in UPSC, if you go through the previous year question paper, we will definitely find some questions being asked in this fashion. So I think it's important for you to know. Just know the meaning only. Let's look at the options now. Option 1. Option 1 says it is the ratio of a firm's profit after tax to its interest expense. So according to option 1, it is the ratio of a company, that is the bank's profit, to its interest expense. How much amount of profit a bank has earned, and out of which how much amount of interest that it has to make. Now let's have a look at option B. The ratio of firms' interest payments to its principal payment. It is about how much amount of interest the bank has to pay out of the total principal money that it has to repay, kind of our effective revenue receipts type of thing. Option C, ratio of banks' total interest payments to its total external debt. So out of the total external debt that it has, a bank has, how much amount of total interest payments the bank has to make. Option D, the ratio of bank's total assets to its total liabilities. I think we can very well eliminate option D. Why? Because it is something that is called as asset to liability ratio, that is called as a leverage ratio kind of thing. So we can eliminate option D, and option C and option B are again easy to eliminate. Why? Because it is given to confuse you, but there is no proper definition of these terms indicating any other kind of ratios like your capital adequacy ratio, debt to asset ratio, etc. So the answer for this question is option A. That is, it is the ratio of the firm's profit after tax to its interest expense. So if I am a bank, if I earn rupees 10 lakh as my profit, and if I have to pay tax amount of rupees 1.5 lakh, okay, and if I have to make the interest repayments of rupees 20,000, okay, maybe 80,000, okay, then what would be my interest coverage ratio? Interest coverage ratio would be the profit after tax. So after deducting 10 lakhs from 1.5, it is 8.5 lakh profit after tax to the what is the total amount of interest expense that you have? That is 80,000. So why I have to find out this ratio in first place? To decide or to get an idea of whether I will be able to make the interest repayments with whatever amount that I earn as a profit. So depending upon your profits, you are finding out whether I will be able to cover up my interest payments or not. It is just an indication for you to know whether you have enough resources with you or not. It is as simple as that. I think you would also be familiar with capital adequacy ratio, right? So this is again going to decide whether you will be having enough amount of capital resources with you to cover the potential losses, if any, that occurs because of you lending to risky assets, right? So it is the ratio of what? Capital to risk weighted assets. Similarly, we have many other ratios as well, like your debt to asset ratio, leverage ratio, equity ratio, etc., debt to equity ratio, etc. But this particular ratio is going to give you an idea about how many times a company can cover its current interest payments with available earnings that it has. It's going to easily help you determine whether a firm can cover the interest payments of its total outstanding debt or not. So if the ratio value is increasing, if the ratio is higher, it means that the company has enough potential to repay the interest payments, right? So if the ratio is lower, then probably the company has to take some kind of measure so as to deal with the interest repayment requirements. But if this ratio value is going less than 1%, then the company should take this seriously as a warning so as to avoid any kind of bankruptcy situations. So this is about your interest coverage ratio. So what is the interest coverage ratio? It is the ratio of firm's profit after tax to its interest expenses. Now, moving on to the second question. Which of the following are the objectives of one state, one regional rural bank? If you are following the newspaper, I think you would be familiar with this, that the government has proposed to go for fourth phase of amalgamations of the regional rural banks. So it all started in the year 2004 to 5. And so far, we have done 3 successful phases of consolidating regional rural banks. And in this fourth phase, it was proposed to consolidate the total number of regional rural banks from 43 to 28 in such a way that every state has one regional rural bank. Okay, so this question is asking you to find out the potential significances of going for such a kind of consolidation. Right now, only 12 states in India, including the states like Andhra Pradesh, Karnataka, Bihar, West Bengal and Gujarat, have more than one regional rural bank. Almost all the states now have only one regional rural bank in it. Why? Earlier it was somewhere about 196 in number. We went for consolidations. Why? Because we have to get the benefits of scale. We have to cater to the capital needs of each of the regional rural banks in such a way that we are able to increase its operational efficiency, increase its area of exposure and increase the utilization of technology and everything. So whenever a question of this type comes, you have to go through the options, and if at all there is some option which is totally not relevant to the advantage perspective, you can simply go with all the above. Okay, see, improved exposure, almost yes, because you have one regional rural bank for one state. Uniformity, obviously. So enhanced capital base, so the government can spend more money on regional rural banks if the number of banks are less. So increased area of operation, of course, yes. Reduction in overhead cost, operational cost is going to get reduced. So all the above is the correct answer for the second question. It is a very easy question, but just you have to follow the news regularly so as to get the updates about this regional rural bank amalgamations. Moving forward from here, we have another very important question, that is your money multiplier. As far as UPSC is concerned, every year almost on an alternate year, definitely you will find a question from money multiplier. I think it's the favorite topic for UPSC. So here the money multiplier question is asking you to find out in what conditions increase in, okay, just a second. So money multiplier question is asking you to find out the money multiplier in an economy increases with which one of the following conditions: increase in cash reserve ratio, increase in statutory liquidity ratio, increase in banking habit, and increase in population of the country. So to answer this, we have to know what is money multiplier, right? So money multiplier is nothing but it is the term that is going to decide how much amount of money that a bank has created. So if the money multiplier is higher, it means that bank has generated more amount of money or credit. If the money multiplier value is less, it means that bank has generated less amount of money. So let's understand this with the help of example. If you get rupees 100 from your parents, and if you are saving 20 rupees, if you keep 20 rupees as a reserve and spend only 80 rupees, it means that you are injecting 80 rupees into the market. So what is the reserve value here? It is 20. What is the money that you injected into the market? Say for example, if you are a banker, if you are lending 80 rupees to the people and keeping 20 rupees as a reserve, then it means that you have created 80 rupees of money in the market, right? So this is the value of money that you created. But now let me know, if you are increasing this value of 20 to somewhere 40 or 50, then you will be able to generate only what? 50 rupees as a money in the market, right? So whenever the reserve value is increasing, sorry, whenever the reserve value is increasing, the value of money that you created is decreasing. That is why we say money multiplier is inversely proportional to the reserve value. Clear? So now read all these options. The question is asking you in which of the conditions the money multiplier value is going to get increased. It is very clear. Whenever the value of reserves are decreasing, okay, whenever the value of reserves are decreasing, then money multiplier will increase. But whenever the values of reserves increases, money multiplier decreases. So giving loans is just one way of creating money. We also have so many other options like banks taking part in open market operations, this, that, and all those things. Let's understand this with simple example. So this is very obvious. So according to this, the first statement is incorrect. Increase in CR. Okay, increase in statutory liquidity ratio, because these are the different types of reserves the bank has to maintain. Increase in banking habit, of course, yes. So if the people are getting into more kind of banking activities, it means that they are depositing, they are getting loans, etc. So when there are more deposits, it will be easy for the banks to lend it, right? Some kind of economic activity is happening there. So according to this question, option C is the correct answer. The money multiplier can increase when there is increase in the habit of banking, banking habits, and this was asked in your previous year UPSC question. So increase in the population of the country, it has nothing to do with money multiplier unless and until the people are involved in the banking activity. I hope this question is clear now. So the correct answer is option C, increase in banking habit. Moving forward from here, we have the next important question, that is central bank digital currency. With reference to central bank digital currency, consider the following statements. You have to definitely know in and out about all forms of digital currencies that exist, bitcoins, cryptocurrencies, and everything. Why? Because these are the recent technological advancements and they have huge amount of potential in the future as well. So definitely you have to read about this. Let's see the options now. Okay, statements. It is a fiat currency. In the previous video, I have discussed about the difference between the fiat money, legal money, commodity money, and all forms of money, right? So talking about the fiat currency, of course, yes. So what is fiat currency? That is something which is backed by the government and it does not have any intrinsic value of its own. Talking about central bank digital currencies, it is definitely backed by the government and it is issued by the central bank. So it is a legal tender. It does not have any fiat, intrinsic value. You cannot use it like your physical currencies in your wallets or whatsoever it is, but it is applicable or available only in the digital format. Going by that definition, option 1 seems to be correct. Moving on to the second statement, it is more secure than the cryptocurrency in terms of encryptions. See, cryptocurrency is also a digital currency, but not all digital currencies are cryptocurrencies. You have to be very careful here. Okay, so this is given for you to understand the difference between cryptocurrencies and the digital currencies. So all types of digital currencies are not cryptocurrencies, but all cryptocurrencies are digital currencies. Talking about the security perspective, this statement says that central bank's digital currency is more secure than cryptocurrency in terms of encryptions. This statement is not true. Why? Because cryptocurrencies run on the basis of a blockchain technology which uses cryptography for encryptions, and that makes it quite secure, and that is why people move towards the cryptocurrencies. Okay, so here we do not have the use of blockchain technology for for the central bank digital currencies, and we do not use the cryptography. So we can simply see who is making how much amount of transactions, like the government is able to see that, the banks can see, etc. Okay, so this is something that is different from the cryptocurrencies, which you have to remember. Talking about the third statement, transactions are visible only to the government, central banks, senders and the receivers. Of course, yes, but anyone on the blockchain can see the transactions happening in the cryptocurrencies, right? So how many of the above statements are correct? Only 2 statements are correct. So the right answer is option B. Have a look at the differences between digital currency and cryptocurrency quickly. Digital currency is any currency, that is money in digital form. It is issued by whom? Either the government or the monetary authority of the country. So it is the fiat currency available in the country in a digital form, and it is called as a, okay, ignore this. Talking about the cryptocurrency. Cryptocurrencies are the subsets of digital currencies. Okay, so it operates on the basis of cryptography. The security and the other operations are decentralized, which means there is no any central authority governing the control of all these cryptocurrencies. In case of digital currency, we have the RBI controlling the operations, right? So it is not getting controlled by any central authority. And then security, validation, transparency, technology, everything relies upon this blockchain, so it is more secure. Cryptocurrencies takes the upper hand over the digital currencies in terms of encryption features. That makes statement 2 invalid, right? Okay, I hope so far everything is clear. We are moving to the last part of the question. Which of the following is not the function of the central bank? Okay, banking facilities for the public, providing credit to the commercial banks, providing financial assistance to the government, banking facilities for the government. Looking at all these all these 4 options, it is clear that option A is not true. Why? See, RBI has nothing to do with providing the banking facilities for the public, but it has to do, banking facilities for the banks as well as for the government. That is why we say RBI is the bankers' bank, RBI is the banks to the government, lender of last resort, all those things, right? So here we will have a quick look at some of the important functions of the Reserve Bank of India, talking about the role of being a regulator. It prescribes the parameters of banking operations. It helps in maintaining the public confidence so as to avoid bankruptcy kind of situations, also things. And manager of foreign exchange, that we know, it issues currency, it plays a development role, it is the regulator and supervisor of payment and settlement systems. Related functions, it is banker to the government. When I say banker to the government, it means it gives loans to the government, it borrows from international institutions on behalf of government, all those things, right? And when I say bankers to the banks, it lends to the banks, it makes transactions with the bank, and whenever the bank is in the state of loss, the RBI is the lender of the last resort, right? So these are some of the objectives of the Central Bank of India, which you have to know. Probably in the next monetary policy video session, I'll make it more clear for you. So that's all for today. And if you are someone who is preparing for UPSC CSE 2025, there is an exciting offer that is going to be happening on November 10, where you will be taking part in the scholarship test to win rewards and scholarships from a pool of rupees 50 crore. Okay, so these are some of the benefits that you can have. Have a look at this Border Gavaskar trophy. You will be able to see that, and then you will have a luxurious family vacation trip. You can also win laptop, smartphones, tablets and everything. So this is something which is highly rewarding, and I hope you all take part in the test. And there is something that is also happening. The offer is going to end on 9th of November, where you can avail a range of courses for just 24,999 rupees, right? So these are some of the benefits that you have. You will be having access to all the batches, Hindi batch, English batch and everything. So I wish you all to take part in this. And if you have not subscribed to UPSC Warriors channel, please subscribe, and see you all in the next MCQ session. If you have any doubts, please post a message in the comment section. Thank you so much for watching. Take care.